What's going on, folks? I hope you guys are having a good day. I am. I'm just heading through Arkansas right now on my way to Texarkana, Texas to deliver down there, and then head over to Dallas and deliver at 2 drops over there, and I'm done. But this is the 4th time I've tried to record this video, so I'm going to give this a whirl again. I'm trying to do a little bit kind of on financing and stocks, and the other 3 got kind of, I guess, all over the place. So I'm going to try to explain one of my plays that I've been playing, and so you guys can kind of copy it and do something along the lines if you want as well. For me, I'm going to base this play, the play that I'm talking about is going to be a Ford options play. To get started, I hold a lot of Ford. I believe in the company. I think what they're doing in the electric car market is going to be huge here in the next few years. I think they're going to have a bit of a step up on everybody but Tesla. And in my personal opinion, I think pretty much all vehicles here in the next 5 to 10 years are going to be some sort of a hybrid. Whether it's full-blown electric, whether it is electric gas hybrid, whether it's electric diesel hybrid, or whether it's going to be a forced air hybrid, kind of like what Ford's doing with the EcoBoost. But that's besides the point. That's kind of why I like to hold a lot of Ford. Ford makes up, I'd say, roughly 12% of my portfolio. So it's not huge, but I like Ford because I think that they are going to grow here in the future. They're having some troubles right now, but I think here in the next 5 to 10 years, they're going to take a fairly substantial market share, and I hold Ford long term. I don't sell unless I'm called on one of my plays. But all right, so we're gonna get into options here, and this is one of the ways I like to play my stocks. I tend to play very conservative, but the play that I'm talking about right now, I have it set up because, and I don't know if you guys listen to them at all. A couple of you, or some of you might, but the Trading Fraternity, that's all on options. And for me, I keep around $1,000 in an options portfolio that I can play around with. Options are a way you can make a lot of money quickly. You can also lose a lot of money quickly. But I play conservative, and the way I play this option that I'm playing is kind of the way the Trading Fraternity describes it. I'm going to use a term that he uses called ghetto dividends. It's another form of drip investing. So right now, the play that I'm talking about is a February 7th put play. I sold the $9 put option for $36, and what that is I sold insurance to somebody that most likely they hold at least 100 shares of Ford. Now, I sold that option for $36 for, it was about a 3-week option play. So what I'm doing is I have guaranteed that person, and really, if you know options, then you can probably fast forward or skip this. This is going to be fairly basic options, kind of telling you or teaching you how to do it. But so what I did is I used a collateral call and a collateral put sell. So my collateral cover is $900. So what they do is they take $900 from my account, and and they put a hold on it. And this is all through Robinhood because, look, for my options, I only use Robinhood. Yeah, I can't get great fast plays with that, but I don't day trade, so I don't really worry about it. I like the free trades, and Robinhood has a fantastic, easy platform to use. So I sold the $9 call for $36. They put a hold on $900. And right now, Ford is trading at, I think, like, today, I think it closed at like $9.18, $9.22, something like that. It's been kind of holding that for the last week and a half here. But I sold the put for $36. I take that $36 and immediately use that to purchase. It would be three shares right then and there at the call price. I think I purchased them at $9.22, but I essentially got 3 shares of Ford for free because someone paid me the $36. Now the risk is I could get called on that put. If the stock falls down below $9, I'm guaranteeing somebody that I will buy 100 shares of Ford from them for $9 a share. So if it drops to $9.90, look, I'm going to lose $100 up front on that share. Wait, yeah, $10 per share, 100 shares. Yeah, it's $100. I will lose $100 from the guy, or 10 cents per share. Yeah. That comes out to $100. I would lose $100 on that play. But for me, I hold long term. So I don't care if I'm going to lose a little bit of money on the upfront purchase of Ford, because I'm holding Ford for the next 30 years. I have no plans on selling it. I like the dividend. It's got a 6.55% yearly dividend on the stocks. So realistically, look, if it drops down below $9, I get called, I'm going to have another 6% on $850, or it would be $890. So yeah, I would have lost $10. Yeah, I thought I was a little off on that. So I would lose $10 total on that play. But I mean, look, at the end of the year, I'm going to make more than that. And then what I do is I constantly build the portfolio. I'm building it. If I get called, I purchased 3 free shares because they gave me the $36. I'm also purchasing those 100 shares. So I realistically got 103 shares. 100 of them I purchased with my own money. 3 shares I got for free. If it doesn't drop below $9 per share, then they're obviously not going to call me. I'm going to get full access to my $900 again. And I'm going to start looking for another $30+ put play that I can do. Probably it'll be right around $9 again. And they'll put a hold on my $900. Let's say I get another $30. And now, because of my extra money I got for the $36 play, and let's say I got $30, now I'm going to be able to buy 4 shares. Well, it'll probably be another 3-week to a month play. So they're going to hold my money for another 3 weeks to a month. But in that time frame, I was literally paid, what would that be, $66 total to now own 7 free shares of Ford. And if you do that constantly over and over and over and over and over again over a time frame, you're going to steadily build up your account by really not spending any money. Because you're going to get the dividends, you're going to take that dividend and immediately turn that right back into Ford and buy more shares. You're also getting the insurance payments which you're turning right back into Ford. And the fun part is, once you have at least 100 shares, you can now use your shares as collateral to sell call options. So now you can sell a Ford put option, let's say for $30, and then you, in the same time frame, get to sell a Ford call option, which right now they're not trading for much, $9, $10, but you get to sell a call option for another $9 or $10 for 3 weeks to a month, you're using $900 cash as the collateral for the put. You're using your 100 shares of Ford as collateral for the call, and you just got, well, if you would have done it before, when I did the $36 play, you would have gotten a total of $46. Now $46 divided by, let's say $9, well, let's just say $10 a play, that gives you 10.6 shares. So you would have gotten 4 shares at $9. I think you would have been able to get roughly 5 shares. Yeah, that would have been 45 bucks, give or take a couple pennies here. But roughly $45, you would have been able to have gotten 5 shares of Ford for free. You didn't put any money into the market to buy these shares, but you literally got paid because you sold insurance. You would have gotten paid to buy those shares. So essentially, like the trading fraternity says, you can log into him. He's on YouTube. Look up the trading fraternity. Has a ton of great videos, and he does a daily. He is on all day long live trading while the market's open. So 7 hours a day, he's on live. But so you essentially got your free shares, and you're building your account almost for free. So I will get more into the call end tomorrow. If you guys really like this kind of stuff, I can talk about it a lot more. But for right now, I think the video's long enough. I'm at 12 minutes and 40 seconds. So yeah, that's just a quick option, or a quick thing on put options being covered with like a cash covered put sell option. You can make a lot more. There's a lot of different ways to play. You can use spreads. If you have less money, it'll take less collateral. You can buy them yourself. If you expect Ford to go down below $9, you could have bought the $9 put option, and you can make a lot more money. That's when you can get 1,000% for your play. But that's much more risk. So I'm gonna leave it there. If you guys like this kind of stuff, please hit the like button and comment down below if you have any questions. Don't take this as trading advice. This is just how I'm doing it. If you guys want to play that way, awesome. If you don't, that's fine too. But yeah, that's just a little bit of the way I trade. I trade my options. So yeah, sorry, just hit the like button, subscribe, and leave a comment of what you think about this kind of information. I'll try to do more if you guys like it. But thanks a lot. Have a good day. I will see you guys tomorrow.